Hi,
Ladies and gentlemen, thank you for standing by and welcome to Pengana Australian Equities Fund quarterly update. At this time, all participants are in a listen-only mode. Following the presentation, there will be a question and answer session. We will be taking questions online via web panel. To submit a question online via web panel, please type your question in the Q&A box located on the bottom left of your screen. I would now like to hand the call over to your host for the day, Mr. Reid Kessler. Please go ahead, sir.
Hi, good afternoon, and thank you everybody for joining us on this webinar. So we're not that practiced at doing webinars. I'm usually in front of everybody, so you'll please excuse me if I get a couple of slides wrong or don't move them forward. So it is effectively an update on the last quarter, the quarter ending March, and look, it's very interesting that at the moment we're very happy with our quarter's performance. I'm going to turn the slide to that. So we're not getting much luck with this slide. So operator, if you could just make sure that we go to the next slide, because I've lost control of these slides. Okay. Thank you, operator. So, small glitch. Okay, so the fund performance, particularly for the last quarter, was exceptionally strong. We did over 8% over a 3-month period. Remember that our target is the risk-free rate, which is currently about 2% plus another 6 over a year. That's 8% for the year, and we've done that in a quarter. I was exceptionally surprised by that. I went back and did a lot of research on it, try to work out why it was so strong. Obviously, the market was a strong environment, but more importantly, we've got a very, very conservatively positioned portfolio, because we're concerned, as you'll hear later, about the weight of money rushing into equities and the impact it's having on valuations generally. So our performance came from 3 events mainly, and I guess if you're investing in good companies run by competent management at the right price, and we've only got about 25 stocks in the portfolio, then you would expect management to do something really smart, maybe once a year within that group. We've had 3 really transformational effects from management within the last quarter, and I'll go through those in a little bit more detail later. So reminding you that on the fund performance, we continue to be very solid. Our target has been, since inception, has been the risk-free rate plus 6. The average risk-free rate since inception has been about 4%. So we should expect about 10. We've averaged 13% in what I call drive away, no more to pay. And we've had quite a tough environment with equity markets done about 7. So we've had a bit of a headwind, but we've managed to perform quite well in that environment. Operator, if I take you to the next slide then. So I've mentioned a few times why we're cautious. We're cautious because of 4 main reasons. First of all is that you must remember that we're investing equities or long duration assets, and as the cost of money drops, long duration assets should go up in value. And we think that's effectively what's happened. We joke about this, investors being stuck between TINA and FOMO. TINA stands for there is no alternative. So if you keep your money in the bank or you put it into property, you're going to virtually any asset class, fixed interest, the returns are very, very low. And then FOMO stands for fear of missing out. Now, if the equity market's done 10% over the last quarter, you can imagine that everybody who is in cash is looking at these numbers very jealously. And there's been a huge capitulation, people taking money out of cash and putting it into shares. And that weight of money is driving the equity market higher. Secondly, you've got monetary authorities throwing virtually everything, including the kitchen sink, at trying to kickstart the economy, their economies. And they're trying a lot of tricks that they've tried before and some that have never been tried before. We've got quantitative easing, which is having an impact of investors actually paying banks money for the pleasure of giving them their money. That's negative interest rates, unforeseen since records have been kept. So this is quite a difficult period. Thirdly, valuations are quite high. There's no doubt that it's not a cheap market. Now, that doesn't mean that there aren't opportunities. It just means that you have to be exceptionally disciplined. And a lot of people think that the tough part about managing money is when there's a lot of storms around. So when Greece falls over, when there's a tsunami, when a couple of companies go bankrupt, and I take an opposite view, given my conservative nature. I take the view that the real storms occur when frothy markets come, when things appear to be absolutely fantastic. And that's the environment that we've got at the moment, where if you're a momentum player, you're having a party, asset prices keep going up, and all you have to do is jump along for the ride. We believe that you have to keep your hands very firmly on your discipline, because the moment you take your hands off and reach for those prizes that just appear to be too good, that's when you're going to founder. So we've still got about 25% of the portfolio in cash, and we've taken out quite a bit of insurance, which I'll talk about in a minute. The last one is the currency war implications. There's a lot of talk in the press about the US dollar strong, it's weak, the Aussie dollar strong or weak, but essentially what's happening in the backdrop is that monetary authorities or governments around the globe are trying to kickstart their economies by debasing their currencies. Now, the euro and the Japanese have done an exceptional job, and it seems to be a race to the bottom. And remember that's a major trade-off between Japanese capital equipment exports and German exports. And it's only lately that the Australian Reserve Bank has realized that we have to partake in this currency war, and that's why we've been cutting interest rates to a large extent. And that's going to have a big effect on a lot of things. We've got about we used to have about 30% of the portfolio exposed to non-Aussie dollar earning streams. So as the currency fell from $1.10 down to about 80 cents, we made a lot of money. At that stage, I was uncertain as to where the currency was going to go, so we took a lot of our bets off at that area. In hindsight, we probably should have kept them on, but we don't try to guess the currency, and we're happy at the situation where we are. Operator, if I could go to the next slide, that'd be great. So in terms of the outlook, and look, we're not very good at the macro stuff. We have to be aware of it, but essentially we bottom-up stock pickers. So I'll just give some broad statements about the outlook. We think the US economy is improving. It's a bit patchy. The Europeans and particularly the Chinese of late are what I'd call kicking the can down the road. And that means that when every time there's a bump in the economic growth, all they do is they cut interest rates. And that's not going to end well. How will markets perform over the next 6 months? Probably the most frequently asked question. And you'll probably be disappointed by my answer, but my answer is I have no idea. I don't think anyone in my team has any idea. Anybody who can take financials, industrials, resources, guess them correctly, put them all together, guess the currency in 6 months' time, and then most importantly, guess whether the fear button or the greed button is going to be pushed, is an absolute genius on a number of different fronts. We don't try to do that. All we try to do is look for good deals where we've got a big margin of safety that we can apply money to. And the fact that we've got so much cash tells you that those deals are hard to come by. I've already mentioned the capitulation of money into equities on that due to TINA and FOMO. And interestingly enough, we're seeing some really good signs of a recovery, particularly on the East Coast. So some of the interesting signs, very good lead indicators that have always served us quite well. There's a traditional one where the ANZ small business lending growth has been quite strong. But my personal favorite is we do a tour of all the RSLs, and the pokie machine revenues are up quite strongly. That shows you there's a lot of cash around, and that's particularly due to petrol prices being lower. And then building supplies companies like for likes are quite strong. So thank you, operator. If we can go to the next one. So those are broad macros that we have to operate within. So it means underlying business activity is not too bad. It's just that valuations are quite expensive. And so what we're doing is we're looking for themes within this where we can look for good deals to deploy money into. One is, there's no doubt that the ongoing bifurcation, and apologies for the long words, but there's really a split of where the money's going in the current economy. The rich are definitely getting richer, so if you've got assets, either equities or property or your own business, you're getting a lot wealthier. If you're a blue collar, white collar, you've probably got a bit of job insecurity and you haven't had a wage increase for some time, so that could be problematic. There's a real trade-off at the moment. Generally, fund managers are paying up for resilient defensive businesses, and so you're being asked that if you want to participate in those, you have to pay a big price. What I call corporate Darwinism is certainly accelerating. So the strong are getting stronger, and big companies are using their muscle to make their businesses better and taking business away from the smaller players. I think that the adjustment Australian dollar will be very positive for our economy, particularly in tourism, education, agriculture, and to some extent even resources. Some companies are breaking even now purely as a result of the Aussie dollar falling so much because they're getting more Aussie dollars for every US dollar worth of commodity they're selling. Aged care demand continues to build. This baby boomer continues to come through, and we've made good money out of that, and I think we'll continue to. And then as a little side piece, I'll just say that disruptive technologies, particularly brought about by online and big data, are having a real impact on business models. Certain companies are using them extremely well to make their businesses better, but others are having problems. If we just go to the next slide, operator. So key portfolio themes. So we've made a lot of money out of our non-Aussie dollar earning streams, and I mentioned a few there. I've spoken about aged care already. And then we've also broadened our exposure to companies we think will benefit from higher disposable income spending, particularly due to lower interest rates and lower petrol prices. And we've already done quite well of those. I must stress, we're not trying to guess the economic cycle. What we are doing is we're buying companies where even if the economic cycle doesn't improve, we can do quite well, but you've got a nice option if more money does flow through the economy. Most importantly, we think markets generally are expensive, and so we've bought some insurance. We've bought puts on the market, 6-month out puts, so that in other words, they have a life of 6 months, and they're 5% out of the money, so that they don't really kick in unless the market falls by more than 5%. Now, we hope and pray that we can tear these up as worthless, but when you insure your house, you absolutely don't want to claim on a fire. Well, some people do, but it's not us. What we want to do is we want to sleep at night. So knowing we've got this protection in place means we can sleep at night. And as you can imagine, having a very strong quarter of 8 and a bit %, you can certainly afford to scrape off some for insurance. If we go to the next slide, get down to the nitty-gritty. What were the top contributors to the fund? I've got the top 5 there. Without doubt, ResMed, ANZ, TAS Group, RCG Group and Credit Corp were our strongest performers over the quarter. Several of them, in fact most of them, were transformational deals done by management which really, really lifted the underlying fundamental value in those businesses. ResMed's come out with a new product that leapfrogs its competitors. It's effectively an online sleep apnea device, much like your Kindle. They've connected it to what they call the SleepNet or the WhisperNet, I guess is the equivalent. And that allows them to, solve the problem of compliance as to whether the customer is actually using it or not, and certainly alleviate their customers, which are the middlemen, from having to follow up on their compliance. RCG Group, absolutely amazing deal in the last couple of months, where they bought a business bigger than themselves with much stronger growth at half the multiple of their existing business. We were asked to participate in a capital raising to do that at 70 cents, and there was a 30% earnings uplift as a result of that. The stock's been only mildly re-rated. We still think it's very cheap, and it's now trading at $1.10. And Credit Corp has built a business organically, which for accounting purposes, it's showing a loss, a small loss, but in cash flow terms is making real money, and that stock continues to be very, very cheap. Our problem children are Mermaid Marine. That's been a long-standing one. We're virtually out of it. Our biggest asset left in that business now is some remaining tax loss. I hate saying that. It's been certainly our biggest mistake we've made since the start of the fund. It's cost us about 1% in performance, and we've taken steps to rectify that. And then the PAS Group is a discretionary retailer that was too cheap and was too cheap for a reason, and we've got that one wrong. Thank you. If we can go to the next slide, please, operator. So, what have we actually done during the quarter, besides where we made our money? What steps have we taken? Well, we've increased our holdings, particularly in Caltex. That was following the big sell down by Chevron. It now is probably one of our top 3 holdings. We've topped up on our ANZ at really nice levels. We've bought quite a few more Telstra, and we've bought a lot of Credit Corp. Our new holding, we bought a very small holding in Doneco. This is a gaming company that just bought a business in Cambodia, which makes a ton of money from a good recurring annuity stream, which is mainly gaming machines, and that's what attracted us. We've we've disposed of our Woolworths. I call that our miraculous escape. We got increasingly uneasy with our holding in it, and leading up to the results, there was a very strong move in the share price upwards as people who were shorted didn't want to take the risk going into the results. We decided to take that gift and we exited, and in hindsight, it's probably one of our smarter and luckier moves. But it really gives credence to our view that if we don't know, we don't play. We sold Macmillan Shakespeare. We've made, it's probably been one of our biggest contributors since inception, but we feel it's now fully valued, and then we took advantage of a very nice 80% premium bid for the current share price in China in the Cloud by a Japanese company, similar to Toll, to sell out that China in the Cloud. And then, really reducing our holdings in TAT, Duet, and ResMed. If they, amongst your biggest holdings at a certain price and they go up 15 to 20%, you still like them, just not as much, and you don't want as much exposure. So I think that was more prudent portfolio management. And then I've already spoken about the puts we bought in the market. Thank you, operator. We can go to the next one. So on portfolio exposures, here's a typical slide that many of you have seen. It's quite color-coded. The ones in red show that they are defensive. So that's where we don't have to guess what the economic cycle is going to do. Financials are a bit different because the widgets you sell are effectively money or dollars, and so you have to think about interest rates differently. The one that probably pops up that's unusual for us is resources. Yes, we do own a 3% stake in a resource company, believe it or not, for the first time since inception. The company is Rio. 70 cents in every dollar you put into Rio is iron ore. It is the lowest cost producer by a country mile. So we think we don't have to guess the iron ore price or what it's going to do, because even at this level where more than 50% of the market is out of business, if they produce iron ore at this price, Rio still makes a very healthy return capable of paying us a 6% after-tax cash earnings yield. And I think their strategy is very deliberate. They are cleaning up the industry to improve its structure for the benefit of its shareholders, which we're now one. So we're very comfortable with that holding. And yes, it is unusual, but we've done our homework. As you can see, high cash level, and our non-Aussie dollar earnings stream is down to 20%. And I guess I'd point out that the portfolio is not your typical, top 10 of the index type portfolio. There are some very different holdings there. We think some of the top 10 holdings or top 10 index or the biggest companies on the ASX are too expensive due to the weight of money, not due to their business models, but the sheer weight of money, and we steered away from them. And thank you. If I can go to the next slide, please, operator. All right, so here's some examples of the companies that we've bought. I am going to run out of time, so I've put them up there. I know you can revisit them at any time. And maybe I'll just go through ResMed very quickly, and then the rest are all the same. Essentially, we ask ourselves the first question, what are we buying? For every 50 cents we put into the business, we're buying a 50 cents or grossed up $4.9 billion worth of value. We're buying a business that sells reverse vacuum cleaners, where effectively, using a very clever algorithm, while you're sleeping, it puts pressure into your respiratory system. And then the other 50% is once you've sold them the flow generator, they have to buy masks, 2 to 3 every year, and there's about a 90% margin on the masks. So it's kind of like the razor blade holder and razor blades business model. Is the business a good business? That's the question we ask ourselves next. Well, we think it is, and there's a whole lot of reasons there why we do think it is. Is management competent? Look, they've always under-promised and over-delivered. They've consistently managed industry-leading innovations, and they have absolutely managed the areas they need to manage in their thing, particularly reimbursement. And also they've had 75 consecutive quarters of growth, which I don't know any other companies that have done that. Can we acquire it at the right price? We think we can buy it on a sustainable after-tax cash earnings yield of 6%, growing at 15% per annum. And remember, it provides us exposure to global economy and currencies. And that's why it's a big part of our portfolio. I've got Credit Corp in a similar, sorry, operator, just flip to the next one, please. I've got Credit Corp as well in a very similar pattern. I guess what's worth pointing out is it's a massive latent franking credit holder. So we think 15 cents in every dollar they could release as a dividend, fully franked, in excess to the business's needs. And we're waiting patiently on that while they build the business quite nicely. If you go to the next slide, this is fascinating. Here's a business that has just bought Accent, and this was a transformational deal run by a very good management team, very cautious. Even after this deal, they've got hardly any debt. They're now the biggest footwear player in Australia, and they're vertically integrated. These are top quality retail managers. If we can go to the next slide, please. CSL. I'll leave these for you to read at your leisure. And then please to the next one, which is Market Puts, which is really so Rhett and all his investors can sleep at night. And then I guess if we skip through that, go to cash holdings. Just the next slide, please, operator. So this is an interesting thing. A lot of people say to me, Rhett, you've got a lot of cash. Why should we put money into the fund now if you're going to just be holding cash? Well, there's two reasons. First and foremost, it's not just cash. 75% of it is invested, and we've done quite well out of that. Secondly, what I find is even when things look ridiculously expensive like they did last month, opportunities pop up. Strange enough, just when I think of markets at its most expensive, we had 3 opportunities to deploy quite substantial amounts of cash. So being able to time the market is not our forte at all. Frankly, I don't think anyone does it well, but we certainly don't. What we do every day is look for opportunities. We're very disciplined. When there's opportunities abound, we buy them. When they're not, we sell them, or we sit in cash. So that slide shows you what our cash content has been. So I should say our equity content has been. So remember that the bottom axis shows we've been up to 50% invested, and you can see we've been substantially above that for most of the life of the fund. So at the moment, you can see the bar goes up to 75%. So it means we're 75% in equities, 25% in cash. The red line is whether we had a tailwind or a headwind, and that's the equity market. And then the blue line is ourselves. And my job is to make sure that that blue line continues to grow. And we've done that quite successfully. You'll see that we're quite active and quite disciplined in looking for opportunities, and we take our time. What's interesting, a lot of people have noted that it's very rare, it's hard to understand, I should say, how we've managed to generate the returns we have with that level of equity exposure. And I would say that there's probably a couple of reasons. We could have been more aggressive in hindsight and taken bigger bets in the stocks that we hold, and we would have done even better, but that's not our style. Secondly, one of the biggest ways to generate performance and to preserve capital is not to lose money. So there's been a whole tail of stocks that we could have bought and would have lost money on that when we didn't know, we didn't play. Now, if you have to be 95% invested, remember you're trying to find stocks that will lose less than the next guy if you can't find anything to buy. That's not good enough for where we put our money. We like to put money only in stocks where we know how we're going to preserve capital and we know how we're going to make money. So that's the long and the short of it. That's the update. There's now a facility where you guys can ask questions. And I see we've already got 3. So what I might do is I'll read out the question, then I'll answer it. If you feel that I haven't answered it properly, please just type in a follow-on and I'll come back to you on it. First question is, how much do you carry in cash at any time? And look, we carry, whatever we don't have in the equities sits in cash. There's a little bit of difference because what we treat as cash is cash we haven't received. It's gone ex-divi, but we haven't got the dividends yet, or we've bought shares, but we haven't paid for them yet, etc. But it's pretty close to what's not invested in equities is cash. It varies. It's been as, from that chart you can see, it's been as little as 8% of the portfolio, and it's been as big as 45%. And when I say cash, just to round it off, we don't just leave it with our custody and settlement guy, who we call the burglars because they pay us less than the RBA cash rate. We make sure that we have rolling, short-term term deposits so that we maximize our cash return. Second question is, what proportion of the portfolio is hedged to the puts you mentioned? We've currently got, at a full delta of 1, it would be 10% of the portfolio. The delta is currently at 0.4, so I guess it's only 4% of the portfolio, but if the market falls, that delta goes up pretty quickly. So it's between 4 and 10%, I guess is the best answer. I suspect that we will be taking more on, particularly if the market continues its strength. The next question is, what is RCG? RCG Group is a listed company that owns Athlete's Foot and the Merrell brands, and it's just bought Ascent, which holds the Skechers and Vans and Diesel brands. And they operate Athlete's Foot on a franchise model. They own a lot of concept stores, so Merrell's stores they own, and then Skechers, and then they've also got a wholesale business where they sell Merrell's and a couple of other brands, Caterpillar, into other retailers, including their franchisees. And Skechers has got exactly the same model, except they don't have franchisees. So that together they've got well over 300 retail outlets now that they own. Okay, the next question is, the FUM has grown to $550 million due to inflows and good performance. If both those factors persist, it will grow further. Do you have any thoughts around your FUM limit or how you apply your increased FUM in terms of companies and geographical markets? Okay, so that's a good question. So remember that we have my own money in the fund and we have a performance fee, so we are absolutely focused on performance generation rather than asset gathering. When we started, yes, it was easier to move around ideas that we found, but finding ideas was hard because it was one-way traffic. We had to go and get every one of those ideas ourselves. And we had very little power in the market because of our size to make those ideas come to us. Now, as we're getting bigger, we're able to go out and use some muscle. An example would be Credit Corp. We know there's a big seller. We've actually approached him directly and offered it to buy some stock of him directly because we can. Now, if we turned up and said we'd like to buy a couple of $100,000 worth of stock, he'd say, why are you coming to me, just do it through the broker? But we can now approach him and say we want a few $1 million worth of stock. That makes a difference. Companies are calling us because they want us to participate, a la RCG Group. They had a capital placement. They wanted us to be, cornerstone. So these are things that happen when you've got a bit of power. However, at some stage, you don't get enough more power to make up for your lack of flexibility. And so we think there's an optimum level there. I think it's somewhere around between 750 and $1 billion. Right? I don't know. Believe me, as soon as we run out of flexibility, we will make some decisions. We are exploring the 20% outside Australia, where we're allowed to buy in industries we know and love already in Australia, and we're looking at 2 really good opportunities that we may or may not take. If we can show that we can transport this capability offshore other than New Zealand, where we've already done it very convincingly, but New Zealand's not that different to Australia, then obviously that impacts quite substantially on our capacity. But certainly the business model works very well at these levels, so we don't feel the need to grow a hell of a lot more. So hopefully that answers that question. A view on the banks, are they looking expensive? Yes and no, I guess, if I had to sit on the fence. We think particularly ANZ offers good value. That's where our biggest holding is in the fund. We think banks are great businesses. Are they expensive? Look, historically, there's no doubt they're at the upper end of their valuation ratios. However, funding has never been in a better situation for the banks. They're able to raise enormous amounts of capital in offshore markets at ridiculously low rates, and the deposit war is well and truly over. And as a result, their cost of funding is going down very, very quickly. So I wouldn't say they're cheap, but I still think they're good value. My biggest issue is if valuations generally take a haircut in Australia, you will have a general devaluation, and that will cost us money. And that's one of the main reasons why we've taken the puts on the XJO, is mainly against our bank exposure. We think our other equities stand on their own 2 feet. Banks a lot harder because of the gearing levels inside them, and so we've taken action to protect that. Bear in mind that if you hold ANZ, you're going to get 5 to 6% fully franked dividends, and you're going to get 5 to 6% growth. If, and a big if the rating stays the same, that's 12% per annum. That's great. But what if the rating doesn't stay the same? So, whether the greed button or the fear button is going to be pushed in a year's time, we don't know. So we've taken some protection while the greed button is well and truly pushed. Look, there's a question, why is the Small Companies Fund closed? Looking to invest, just closed, you mean closed to new investors? Really, you should take that up with the marketing guys for the Small Companies Fund. It does show discipline within the Pengana group that when the fund gets to a level we think is starting to become inefficient, we take action. So we're not always swayed by the weight of money. We really mean it when we say we've got capacity constraints. Next question, what concerned you about, I assume that's Macmillan Shakespeare, the code's MMS. If it's not, please type that it is. But what concerned you about the MMS, given it was a previous large holding? Look, there's a few things. Management's changed, and I'm sure the new management's very good, but we knew and trusted the old management, and we don't know the new management yet. So that's one. Secondly, the nature of the business is very much focused on novated leasing. That's the major driver of the profitability. We sold it before they bought this new business, which I think is quite a good purchase. And so we started looking at it again. In addition, we've got a very big exposure to SG Fleet, and it gave us, okay, so I'm going to stop right there and talk about Mermaid Marine, because he was asking about Mermaid Marine, not Macmillan Shakespeare. Apologies for that, John. So Mermaid Marine, the activity in the Northwest Shelf has come off much faster than we thought it would. And the leverage to the supply base, which we viewed as a bit of a utility, is significantly affected by that. The fall in the oil price has been so drastic that it has affected the demand, the viability and pricing of LNG, which is the main product that comes out of those areas. And as a result, we don't know where the level will fall to. Due to its fall, it will really become a very small holding in the portfolio. And as I said, the value of holding such a small holding in the portfolio was outweighed by the capital gains tax loss. Due to our inability to work out where it was going from this level, because of, we couldn't put our hand on our heart and say activity levels were sustainable, and at what level they would base, we decided to take profits. So what did we get wrong? I guess going around back to there's another question on Mermaid Marine. What did we get wrong with Mermaid Marine? Essentially, we misunderstood the leverage in the supply base, and we were unprepared. In hindsight, we were unprepared for this massive fall in the oil price and its impact on the region in terms of exploration and production. Yeah, I mean, I can't put it any simpler than that. So we always say we don't try to guess the things we can't work out. Out of left field came a halving in the oil price, and we weren't prepared for that, for the second and third step logics that knocked on into Mermaid Marine. I don't see any other questions. I hate finishing on a negative note, so I'd really like a positive question, but if not, not. So what I might do then, I'll just talk for a little while, for 30 seconds, and then we'll call it a day, unless there are any more questions. So in summary, I guess, We have made some mistakes, there's no doubt about that, with PAS Group and with Mermaid Marine, and one I haven't spoken about is Seven West Media. Having said that, the small tail of mistakes we've made have been completely outweighed by the long tail of successes. And as a result, our conservative business, our well-diversified portfolio, our focus on after-tax cash earnings yields has stood us in good stead. And we now have got two more questions, so I guess I'll stop the summary at that. Two quick questions. One is a quick comment on Doneco. Look, Doneco is a really interesting business. It appears quite risky, but remember the business model of gaming stocks where you've got good recurring traffic playing gaming machines, which are hard-coded to take a certain amount of money away from them, valued at what we think is a 20% after-tax cash earnings yield, run by competent management and a very conservative balance sheet. We think that's a good bet. So that's why we bought it. It's also, remember, it's a non-Aussie dollar earnings stream because it's US dollars effectively. The second question, Caltex has performed extremely well. I assume you see the sale of Chevron as a positive. Absolutely. This is a business where, again, about 15 cents in every dollar is franking credits, which they could not distribute to their shareholders because the Chevron couldn't use them, and as they had 50%, they kept the money in the business rather than distributing it. Now the company's free to distribute it. Secondly, there were several deals which Caltex wanted to participate in, required additional capital. Chevron did not want to be diluted down, and therefore, at a board level, wouldn't participate, and therefore, at a board level, meant that the Caltex had a pass on them. I think Julian Segal is doing an excellent job. He's transformed the business, and we expect capital management as well as ongoing operational efficiencies. And thirdly, we expect some positive M&A. So, look, I've covered a lot of ground. I've taken up a lot of time. We've been going for 40 minutes. I thank you for calling in. I thank you for your ongoing support, and I hope to continue focusing very much on generating the returns that we strive to, and making sure that your capital is such that we can all sleep at night. Thank you, and operator will sign off there.
Ladies and gentlemen, that does conclude our conference for today. Thank you for participating. You may all disconnect.